In the hours after the Fed's rescue plan was adopted by Congress on Friday, the stock market started stressing over the next worry, the credit markets, dropping 157 points and signaling more trouble ahead for Monday morning.
The news is not good. The bailout package was necessary, but it's not enough to solve the problem.
Analysts are warning of another 4 to 6 weeks of frozen credit markets, while Treasury Secretary Paulson sets up the mechanism to purchase troubled assets from banks.
Business has fallen off the cliff in the last few weeks as a result of the seize up in the credit markets. There is just no borrowing going on. People cannot get financing for anything.
Banks remain fearful of lending to other banks, businesses, and even cities and states. In addition to California's request last week for $7 billion of federal help, 15 states are struggling to plug holes in funding.
It's a little frightening, and I think California is the bellwether because it is so big. And the fact that the credit markets are not available to these municipalities, these governments, is worrisome.
And most economists add that with mounting unemployment, a recession is already upon us and will last into next year.
I see the effects of this lingering financial crisis dampening growth for the next 2 or 3 years.
But there is some hope in the banking sector. The bidding war between Citibank and Wells Fargo for ailing Wachovia signals that some banks have enough cash to bargain hunt. And the Treasury Secretary has hinted there's more in the government's tool chest to help credit markets become confident to lend again.
I think you're going to see all parts of government throw the kitchen sink at supporting the economy.
And fasten your seatbelts. The coming week will likely be a bumpy ride, too. Third quarter earnings reports start to come out this week. That'll give investors a better handle on the health of the economy and could send stocks moving again, although no one knows in which direction.